Trading in financial markets is a high-stakes endeavor where the potential for profits and losses is ever present. Among the many factors that contribute to success in trading, consistency stands out as one of the most critical. Consistency in trading refers to the ability to achieve predictable and reliable results over time. In this comprehensive exploration, we will delve into the multifaceted aspects of why consistency is paramount in trading. Trading is inherently uncertain. The financial markets are influenced by countless variables, including economic data, geopolitical events, and human psychology. This inherent uncertainty means that traders must navigate an environment where outcomes are never guaranteed. Consistency becomes a crucial counterbalance to this uncertainty, providing a degree of stability in an otherwise unpredictable world. Successful trading is not a sprint, it's a marathon. While some traders may experience short-term wins, long-term success requires a consistent approach. The cumulative impact of consistent, well-executed trades over time can significantly outweigh the allure of quick profits and high-risk strategies. Consistency allows traders to stay in the game and continue building their wealth. The primary goal of any trader should be to preserve capital. Consistency in trading is closely tied to effective risk management. Traders who consistently manage their risk by employing techniques such as setting stop-loss orders, diversifying their portfolio, and sizing their positions appropriately are better equipped to withstand losses and continue trading. Emotional control is a fundamental aspect of risk management. Inconsistent trading often results from emotional reactions to market fluctuations. Fear and greed can lead to impulsive decisions that deviate from a trader's well-thought-out strategy. Consistency helps traders maintain emotional discipline, preventing them from making rash choices in response to market fluctuations. A well-defined trading plan is the cornerstone of consistency in trading. It outlines a trader's strategy, risk tolerance, entry and exit points, and other critical parameters. Following a trading plan religiously allows traders to stick to a consistent approach, reducing the likelihood of impulsive or emotionally driven trades. Consistency doesn't mean rigidity. Traders should be consistent in their adherence to a plan but also flexible enough to adapt to changing market conditions. Regularly reviewing and improving their strategies based on past performance and market dynamics is a hallmark of consistent traders. They learn from their mistakes and evolve over time. Inconsistent trading often leads to stress and anxiety. When traders experience erratic results, they may constantly question their abilities and decisions, contributing to emotional turmoil. Consistency in trading, on the other hand, provides a sense of stability and reduces the emotional toll, leading to a more enjoyable and sustainable trading experience. Consistent success in trading breeds confidence. When traders can rely on their strategies and see positive results over time, their self-assurance grows. This confidence allows them to stick with their plan even during challenging periods, avoiding the temptation to abandon their strategies prematurely. For professional traders and fund managers, consistency is paramount in attracting and retaining investors. Investors seek out traders who can consistently deliver positive returns while managing risk effectively. Traders with a track record of consistency are more likely to gain the trust of potential clients and secure long-term partnerships. In the trading world, a reputation for consistency can open doors. Traders who consistently outperform the market or deliver reliable results become respected figures in their field. This reputation can lead to networking opportunities, collaboration requests, and invitations to speak at industry events. Consistency enables traders to gather valuable data over time. By consistently executing their strategies and tracking their results, traders can analyze their performance and make data-driven decisions. This iterative process of learning and adaptation is essential for refining and improving trading strategies. Trading consistently in a particular market or asset class can lead to a deep understanding of its nuances. Over time, traders can develop an intuitive sense of market behavior, enabling them to make more informed decisions. This market mastery is a valuable asset that can enhance consistency and profitability. Inconsistent trading often stems from the gambler's fallacy, the belief that past outcomes influence future results in a predictable manner. Consistent traders recognize that each trade is independent and that there are no guarantees based on previous trades. They make decisions based on their strategy rather than trying to predict the market's next move. Inconsistent traders are more prone to overtrading, chasing losses, and seeking revenge against the market. These behaviors can result in significant losses. Consistent traders, on the other hand, stick to their predefined plan, avoid impulsive actions, and maintain discipline in the face of adversity. Achieving consistency in trading requires ongoing education and self-improvement. Traders must stay up to date with market developments, refine their strategies, and adapt to changing conditions. Consistent traders never stop learning and strive to enhance their skills continuously. Patience and discipline are virtues that consistent traders cultivate. They understand that not every trade will be a winner, and they are prepared to weather losses without deviating from their plan. These qualities enable them to remain steadfast in their approach and avoid impulsive actions. For many traders, the ultimate goal is financial independence. Consistency in trading is a direct path to achieving this goal. Reliable profits over time can provide a steady income stream, allowing traders to reduce their dependence on traditional employment and attain financial freedom. Perhaps one of the most significant rewards of consistency in trading is peace of mind. Knowing that one's trading approach is robust and reliable provides a sense of security and tranquility. This peace of mind extends beyond the trading desk and positively impacts other areas of life. In the world of trading, consistency is not a mere aspiration, it is a necessity. Consistency in risk management, strategy execution, and emotional control is the foundation upon which successful trading is built. It allows traders to navigate the uncertain waters of financial markets with poise and resilience. Through a commitment to continuous improvement and adherence to proven methods, traders can harness the power of consistency to achieve their financial goals and secure their futures in the dynamic world of trading.